I have about 30% of my money in SCHD, probably like you watching this video. But what I discovered has literally shocked me. Is it time to sell? To buy? We will see it later, but something is going deeply wrong with what many once called the safest dividend machine in the market, the SCHD. And if you let today's video slip by, you may not notice the cracks until they swallow a chunk of your nest egg, and by then it will be too late. The next few minutes might be the difference between watching your future erode and pivoting in time to protect it. Let's start from the base. You and I both loved SCHD for the same reasons. Predictable cash flow, boring but solid companies, and a track record that soothed our nerves while tech stocks swung like a pendulum. A full third of my own portfolio still sits in SCHD, as I told you before, so what I am about to reveal hits my wallet exactly the way it hits yours. Yet denial never made a portfolio safer. In the last 2 years, the fund's smooth ride has jerked into a slow-motion skid. Year to date, while the S&P 500 is comfortably green, SCHD is down about 2.5%. The story behind that slide is the storyboard of a bigger problem. Let's expose the first fault line, even if the third one is the worst. Every March, SCHD rebuilds itself. Normally the shuffle is routine, but the March 21st, 2025 rebalance landed in the middle of tariff headlines and wild intraday swings. Defensive stalwarts were sold off, and untested replacements were pulled into the roster at the worst possible moment. In that single quarter, the fund slipped 1.16%, while the same market environment shaved only 0.36% off the S&P 500. One mistimed move turned a defensive ETF into a punching bag, and we were the ones taking the blows. Second, the new lineup supersized energy. Overnight, weight in oil and gas nearly doubled from 12 to 21%. Energy felt like a hero while crude rallied, yet commodities swing harder than any boring dividend stock. The moment oil prices cooled, that extra weight started pulling the fund under the surface. A portfolio built for calm seas suddenly had an anchor strapped to its ankle. And if you don't want to find yourself in these situations and have more and more budget to invest, join our free Telegram community with the link in the description, but I'll tell you more about it later. Third, and the part Wall Street whispers about in closed meetings, risk-free yields crashed the dividend party. 6-month treasury bills and plain money market funds now dangle 4 to 5% with almost no volatility. Institutions that once parked billions in defensive equity funds decided, why juggle stocks when T-bills pay the same? Capital flowed out, share price sagged, and ordinary investors felt the suction without knowing why. If all that sounds academic, let me translate it into the language of your brokerage balance. Suppose you bought $50,000 of SCHD last January. You expected stability and quarterly income. Instead, you're sitting on a paper loss plus a dividend that no longer looks special next to a government-backed money market account. That feeling creeping up your spine right now? That's the realization that a supposedly safe ETF can still bleed when macro forces shift. But wait, didn't SCHD grow 388% from its birth in 2011 to June 2025? Didn't it average roughly 12.4% per year on a total return basis? Absolutely. Numbers don't lie, yet they can disguise the present. Past performance is the rearview mirror, and the windshield currently shows oncoming traffic. Look at the colour table of yearly returns. Only 4 full calendar years ended negative, and the worst drawdown was a mild 5.5%. That data lulled millions into thinking the fund was nearly bulletproof. Unfortunately, bulletproof does not mean future-proof. The same methodology that kept volatility low is now forced to chase yield in cyclical sectors and discard beloved names just as markets get jumpy. The strategy did not change, but the world around it did. So what now? Panic sell and run to cash? Maybe. If your priority is absolute safety over any equity upside, a high-yield savings account or laddered T-bills makes logical sense while the Federal Reserve keeps rates elevated. 4% with zero price swings beats negative 1% with heartburn. Yet rates will fall eventually, and when the yield on cash slides to 2% or less, parking everything in a savings account will quietly lose ground to inflation. That leaves 3 roads, each with trade-offs, and the third I think is the best one, but I'm doing something different, which we'll see later. Road 1. Stay the course with SCHD and brace for a bumpier ride. Accept that the dividend will hover around 3.5% to 4%, and trust that quality screens will reclaim their edge when panic cools. Road 2. Supplement, or even replace, the fund with higher yield covered call ETFs such as GEPI, GPQ, or SPYI. These spin off juicy income by selling call options, but they cap upside and often lag in fast bull markets. Road 3. Tilt toward growth, QQQM, VUG, or sector-specific funds like VGT and SMH, while understanding that the swings cut both ways. Personally, I'm building a hybrid. I keep a core of market weight exposure for growth, a sleeve of covered call funds for income, and a scaled down position in SCHD for ballast, because its long-term discipline still matters. In other words, a simple 3-fund framework shaped to my risk tolerance. Your mix will differ, but the principle stands: do not rely on a single ticker to carry every goal. Before anyone types SCHD is dead money in the comments, understand this. The fund's decline is modest in percentage terms. Emotion magnifies it because we expected tranquility. The real danger is falling asleep at the wheel. Complacency is what turns a manageable dip into a retirement-ending pothole. The smart investor stays awake, watches the macro landscape, and adjusts position size instead of clinging to labels like safe or risky. Remember, total return versus price return. The headline number most apps show is only price. You must tack on the dividend to see the full picture. Even this year, with price down roughly 2.5%, the total loss narrows to about 1.4% once payouts are reinvested. That extra 1% is not trivial. Compound it over decades and the gap grows. Understanding these nuances is how professionals avoid panic selling during temporary slumps. Now here's where panic meets opportunity. Every forced sell-off creates mispricing. If the rebalance error and energy shock continue to weigh on SCHD's net asset value, yields will climb above 4% again. When Treasury yields finally drift lower, income-hungry capital will swing back, compress the yield, and lift price. The patient buyer who locks in the higher yield today could enjoy both recovery, upside, and fatter quarterly checks. Timing that pivot is impossible to perfect, but scaling in gradually over months reduces regret. Still worried? Set a simple rule. If the fund closes below a key support level, pick your favourite moving average, trim exposure by a set percentage, and revisit when momentum turns. Discipline removes guesswork and emotion. No strategy is foolproof, yet rules beat feelings 9 times out of 10. Let's zoom out one more time. The stock market is a story of cycles. Fear, adjustment, recovery, exuberance, repeat. SCHD is not broken beyond repair, it is undergoing a stress test. The reconstitution glitch, the energy overweight, and the bond yield headwind form a perfect storm, but storms pass. Your task is not to predict the exact hour the clouds break. Your task is to keep the financial shelter sturdy enough to outlast the rain. So take inventory tonight. Check how much of your portfolio depends on SCHD's dividend. Decide whether that portion still aligns with your need for safety, income, and growth. Diversify intentionally, not reactively. Use the tools available, covered calls, growth slices, short-term treasuries, to build a portfolio that earns while you sleep and lets you sleep while it earns. In the end, the biggest risk is silence. Funds drift, fees nibble, macro trends flip, and investors who ignore the faint rattle in the engine end up stranded. You have now heard the rattle. Something is going deeply wrong with SCHD, but with clear eyes and steady hands, you can turn that warning light into an entry signal, a lesson, or simply a reason to recalibrate. Whatever you choose, choose before the market chooses for you. For concluding, picture this. You stand on a beach. The water looks calm, yet far out a silent wave is forming. People on the shore laugh, build sand castles, scroll their phones. They cannot feel the pull under their feet. But if you watch the line where sea meets sky, you spot the swell. SCHD is that shoreline now. The tide that once moved in lazy rhythm is starting to surge. The sand under your toes feels softer, less steady. Wait until the foam wraps around your ankles and it will be too late to grab your chair. That's why I repeat, watch now, act now, think now. Don't give tomorrow's version of you a mess that could be fixed tonight. When this video ends, open your account and write 3 short sentences. My goal, my timeline, my safety line. Tape them where you cannot miss them. Read them aloud every morning before the market opens again. But first, of course, be sure to join our free Telegram community, where we'll explain exactly how to start your own successful YouTube business. And thanks to this, you'll have much more money available for your investments. We'll give you our free strategies on how to start a channel completely from scratch, with no budget and without putting your face on the line. So join now, subscribe to the channel, like the video, and let me know your thoughts in the comments. See you soon in the Telegram community. I'll wait for you.